In crypto, volatility is just the name of the game, right? But what if you could turn all that chaos into a consistent strategy? A way to win not just when the market is soaring, but also when it's taking a nosedive. Well, today, we're going to break down a tool that's designed to do, well, exactly that. So, the tool we're going to be looking at today comes from Pionex, a platform that's really well known for its automated trading bots. And we're going to dive deep into their own documentation to really unpack one of their most powerful strategies. And let's be real, this is the million-dollar question, isn't it? I mean, it's easy to feel like a genius in a bull run. But what about the corrections? Is there actually a way to profit from a downturn without having to panic sell everything? Well, according to the source material, the answer is a big yes. The secret? It's a strategy called the Inverse Futures Grid. So let's break down exactly what this thing is and how it's supposed to work. All right, so what is this thing? At its core, it's a grid trading bot, but, and this is a big but, it has a really crucial twist. See, it's designed to earn you profits in the crypto itself. We're talking Bitcoin, Ethereum, you name it. Not in a stablecoin like USDT. And trust me, that one little difference, it changes the entire game. Yeah, this phrase right here, this is a total mindset shift. Investing and earning in non-stable coins. It means your goal isn't just to stack more dollars anymore. The new goal is to stack more of the actual coin you believe in. Okay, so how does this actually play out in the real world? Let's take a look at the very first strategy from the documentation, how to amplify your gains during a massive roaring bull market. All right, let's kick things off with a dream scenario, right? Let's say you get into Bitcoin at $80,000 and boom, it just rockets up to $100,000. So the question is, how would a standard strategy stack up against this inverse grid? Okay, let's see how this actually breaks down. So on the left, you've got your standard trading bot. You start with 8,000 USDT, the grid makes a nice 6,000 in profit, and you end up with 14,000 USDT. Hey, not bad at all. But now look over at the inverse grid on the right. This is where it gets interesting. You start with 0.1 BTC, the grid earns you an extra 0.06 BTC, and because the value of your entire Bitcoin stash has gone up, your total net value is now a whopping 16,000 USDT. And this right here, this is what the source material calls dual gains. I mean, look at that. That's a $2,000 difference. You're making money in two ways at the same time. First, from the bot's actual trades, and second, from the rising price of the crypto you're holding. It's just this incredibly powerful compounding effect. Right, but we all know bull markets don't last forever. So what happens when the music stops and the market turns red? Well, let's look at strategy number 2, using the inverse grid to hedge a downturn without having to sell your coins. Okay, the main goal here is to avoid what the source calls selling too soon. And let's be honest, we've all been there, right? You sell to protect your capital, and then you just have to watch as the price rockets back up without you. Ouch. The solution they propose is to run a short grid. And what that does is it's designed to earn you more coins as the price actually goes down. All right, so let's flip the script completely. Imagine Bitcoin peaks at 100 grand. You start a short grid with 0.1 BTC. And then the price corrects. It drops down to 80,000. So what happens now? Okay, this table it's pretty fascinating. Check this out. So look at that top row first. With 3x leverage, so your trades are amplified, the grid earns you a pretty hefty 0.075 Bitcoin. Now think about that. Even though your initial 0.1 BTC is worth less in dollars, your total stack has grown so much that your net value is actually $14,000. Okay, now look at the bottom row. Even with the much safer 1x leverage, you still earn an extra 0.025 BTC, which, get this, perfectly preserves your initial investment's dollar value. So in both cases, you walk out of a market dip holding more Bitcoin than you started with. That's huge. So what's the big takeaway here? Well, if your goal is just pure low-risk hedging, the documentation is super clear about this. 1x leverage is the way to go. It protects your portfolio's dollar value, you still get to stack more coins, and you're doing it all with a really, really low risk of getting liquidated. All right, so we've covered the market going up, and we've covered it going down. But what about that market that drives everyone crazy? The sideways chop, when it just goes nowhere? Well, that's where our third and final strategy comes into play. Honestly, this is where the GridBot's core logic just really, really shines. So as the market is just fluctuating, chopping back and forth, the bot is working for you 24/7. It's executing all these tiny buy and sell orders, and it's basically turning that annoying volatility into profit. With every single trade, it's adding another little fraction of a coin to your stack. So while everyone else is getting frustrated that the market isn't going anywhere, you're just quietly accumulating, building up your position for that next big move.
Okay, so after looking at all three of these different market conditions, up, down, and sideways, what's the one big takeaway from all of this?
It's this right here. This is really the aha moment of this entire strategy. See, a tool like this fundamentally changes your entire objective. The goal isn't about ending the month with more dollars anymore. Nope. The goal becomes ending the month with a bigger stack of Bitcoin or a fatter bag of Ethereum, just more of the actual asset that you believe in for the long term. And that really leaves us with one final and kind of provocative question that this strategy forces you to ask yourself. When you really look at your long-term plan, what's the real end game for you? Is it to stack more dollars, or is it to stack more crypto? Because honestly, your answer to that one question, it could change how you see the entire market. And that's all for this explainer.